Well, let's move to the markets once again. S&P potentially breaking through key support levels today. We're going to see how we're closed. The number to watch right now is 1292. Some, though, of the big retailing names out there coming out with lowered forecasts. So can the markets keep momentum going as we kick off and get into earnings season? It is going to be a saga. It's going to unfold. James Frischling, co-founder and president of NewOak Capital, joins me now for the hour. You're all about earnings. We know that a lot of the forecasts are going to be negative. How concerned are you about some of these negative forecasts that we've already gotten about the fourth quarter?
Well, I think, first of all, you have the situation where I think we've seen incrementally better economic data. And I think that's setting at least a stage where if investors believe we're at least on the road to recovery or there's some solid traction, I think they can weather some of these negative pre-announcements. In terms of these negative forecasts, we know...
Tiffany, Jim. I mean, we got six. We've already gotten 6 companies saying that forecasts are going to be rough. I mean, names like Tiffany, WebMD.
What we noticed is the ratio of pre-announcements that were negative versus pre-announcements that were positive was about 3 to 1. We haven't seen that type of negativity, let's say, since the height of the recession in '08. And I think that sets a stage, actually, for some surprises to the upside. I'll call it a counterintuitive strategy. If all the bad news is being put out there, then when the earnings start coming out, essentially you have nowhere to go but up. I even think of Alcoa, met the street's expectations, actually maybe is a little light on the earnings, but revenues were a little high, and the market's taking it up. So again, I think the environment is set for a risk-on trade, and I think some of the announcements we're seeing is the management of expectations. And again, the negative ratio, 3 to 1, makes us think that maybe there's some surprises to the upside.
We had corporate profits up 16% back in 2011, which may surprise considering the market performance that we got for 2011. Again, that negative ratio, that 3 to 1 ratio that you're warning your clients about with regards to earnings for this quarter, do you think that is a full year story? Are you more bullish long term, negative short term? What is it, Jim?
I mean, again, I think I'm constructive on the year and looking for some positive growth. I also think, despite all the headwinds that the economy is facing, I think the continued low-rate environment that has been provided to a lot of these companies is starting to these seeds are starting to, I guess, to grow, for lack of a cheesier cliche. But the fact is that these companies have been funding themselves at historically low levels, and that is going to start to, I think, contributed to the plus 16% earnings last year. It's going to help them this year.
You know, next week we're going to have 40 major companies coming out with earnings, and one of them, this is next Friday, is going to be J.P. Morgan.
Yes.
You say that really sets the tone for the financial sector. Why?
I think J.P. Morgan is clearly one of the benchmarks of the U.S. financial companies, and one of the leading 4 banks. And we've talked about our 4-pillar system, Citi, Wells, B of A, but J.P. now comes out first, and I think it does, to a certain extent, set the tone. So we've been constructive on U.S. banks relative to European banks, thinking that they've actually done the recapitalization. They've taken, I guess, more of their lumps. They've improved their balance sheets. It's not easy out there, but I think they're going to come out and it's going to be fairly positive, and I think it does set the tone. And happy to see our friends over at B of A having a little run themselves on back of this.
Well, I have to say you're actually long the U.S. right now, and not versus emerging markets. You're kind of pulling away, so I think that we're going to have some interesting names coming from you later on in the show.
Absolutely.
Jim, thank you. Thanks for being here today.
Much.
Well, coming up. Well, it is time now for the pick. We just talked about Lululemon. They raised their outlook, but overall it's been a real mixed bag for a lot of the retailers. Tiffany's, Signet Jewelers, Liz Claiborne, Home Goods. A lot of these names actually coming out with forecasts that are a little scary. Jim Frischling is not scared. He likes retail. But you say if we're going to look at this sector, you got to break it apart. You got to separate it, right?
That's absolutely right. And the way we separate it was we looked at, there's been a lot of talk about the bottoming or maybe the turning in the housing market, and whether or not that's true, or housing does turn, or the rental markets continue to soar. We think the U.S. consumer has done a better job of saving, reduced some personal debt, and it overall improved its personal, I guess, financial strength. And as a result, we think spending money on the home, improving what you got, is going to benefit the consumer discretionary stocks that focus on housing. So with that in mind, we're talking about things like Bed Bath & Beyond, Williams-Sonoma, light-playing things that are companies that are dominant in their industry. So Bed Bath & Beyond, again, looking at an expansion plan. Oh, sorry.
Well, let me hit you on those 2 names.
Sure.
We're showing a chart of Bed Bath & Beyond, and I want to ask you about this one because, look, if you look at the 1-year chart, I mean, the stock actually had a nice build, but over the last month, and maybe this is too short-term, Jim, in your opinion, but it has slumped about 1% over the last month. The reason I bring that up is because that was December.
Correct. And again, we tend not to look at things in terms of, let's say, month to month or even quarter to quarter, but we are looking for trends. And what we're seeing is with the enthusiasm towards housing, and we are seeing enthusiasm there, we do believe that consumers are going to look to spend money to improve either what they've got or as they move into new homes, again, spending money on the things that they're going to need to make those homes more attractive. We'll call it our nesting strategy. Those who are staying are going to make it look a little more attractive.
Well, I was pretty shocked, I have to say, about Tiffany's forecast. I mean, of all the names that have been kind of the real companies that have delivered year over year to shareholders, Tiffany was really kind of the shining star. And it was the December, I mean, that's the middle of engagement, season for Americans, and Tiffany really got hit. What do you think was behind those numbers, Jim?
Well, when we looked at the Black Friday sales and really the holiday sales, we saw great performance for those people that were able to go the discounting and really create that urgency that you must act now. That's never been Tiffany's strategy. That's not something that they can do. And so to a certain extent, I guess I'm not so surprised that maybe the most high-end or certainly those prized little blue boxes that you can't discount or they weren't going to create that urgency maybe lagged a little bit relative to some of the other companies that were able to kind of execute that must-buy-now strategy.
And even Signet owns like Jared's and what's the other one, K Jewelers. I mean, they've got those chains, and they actually did okay, but not great. So you never know. Jim, thank you very much.
Thanks for having me.